Treasury yields are actually rising today, trading as if there will be a deal. Joining us with more on the bond market's response to S&P's warning is Ajay Rajadhyaksha. He's head of U.S. fixed income strategy over at Barclays Capital. Ajay, good to have you here. Very topical. We talked to John Chambers. The markets seem to be shrugging all of this off. Do you think the markets aren't telling us the right thing or what?
No, I think the markets are just focused on other things right now. One of the reasons why Treasury prices did very well was because if you look at economic data today, it was very poor. Empire State manufacturing was poor, consumer confidence fell. All of those things helped bond prices. But as far as the equity markets go, and the reason why they are not selling off to this reaction is partly because I think the mainstream media in particular seems to have lumped this announcement with a bunch of other announcements which are far less drastic, like the Moody's announcement which came out a couple of days ago. That message has not percolated yet, that this is a much bigger deal. And the second reason is because everyone on the equity side that I know of was far more focused on the European stress test.
So you think the markets are missing the import, if you will, of this latest move by S&P late yesterday?
For the most part, yes. I think one of the things that the market might be missing is the knock-on effects. For example, just before I walked down to have this interview, S&P started putting on credit watch negative Fannie Mae and Freddie Mac, and a bunch of insurance companies, other quasi-governmental agencies, and all of a sudden we've had phone calls from investors at the tail end of the week, mind you, saying, okay, so exactly what does this mean? We didn't think this was even on the cards.
How likely is it, when you look at the cards, do you think that ultimately S&P indeed will do a downgrade of the AAA rating?
I think it is quite possible. It depends on a few things.
But help me out here, because everybody kind of always seems to hedge and says, yeah, it's quite possible if this happens, if this happens, if this happens. I mean, if you had to make a bet today, do you think indeed S&P, I mean, this isn't the first time. They warned us back in April. Now they came out last night.
Right.
How likely is it? I mean, are you starting to make investment bets or advise your clients to say, hey, guys, this is coming, a downgrade is coming?
We are absolutely starting to tell clients that they should at least think about what happens if there is a downgrade, which was not something that we were telling clients in April. And the difference between the April announcement and this one is twofold. One is the April announcement talked about a 1 in 3 chance of a downgrade over a 2-year horizon, which is much more moderate, much more over a medium term. This talks about a 1 in 2 chance of a downgrade over the next 90 days, which is far more immediate. And the second difference, very key in my mind, is that this calls for a very aggressive deficit reduction plan of $4 trillion to be agreed on over the next 90 days.
Right.
I frankly have a hard time seeing policymakers come up with that.
Right. As we watch the wrangling, it just boggles the mind to see that they can get to that point. You know, it's interesting for those investors who might be shrugging off the idea that S&P may follow through with their threat. I want to remind everybody of something John Chambers told us earlier. He was from S&P, dealt with that report. I asked him specifically if the rating agency had the guts to actually downgrade U.S. debt, which some folks in the market question, as we've just been talking about. Here's what John Chambers had to say. Listen up, everyone.
I think that they would have said that back in, last year. In April of this year, we put the U.S. government on a negative outlook. Yesterday, we put both the long and the short-term rating on credit watch negative. We said in pretty clear terms what it would take for the rating to stay. And then the proof is in the pudding.
All right. So, Ajay, I mean, what do you make of that? Does that, to you, sound that S&P really does have the conviction to follow through with this?
I am tempted to take them at face value, and so the answer is yes. I think if the U.S. does not come through with a credible deficit reduction plan, in addition to raising the debt ceiling, I think S&P will end up downgrading the United States.
All right. We're going to leave it there. Ajay, good to get some time with you. Ajay Rajadhyaksha over at Barclays. He's head of U.S. fixed income strategy.